Have you ever looked at a seemingly brilliant business decision and then wondered why the bank account at the end of the month just didn't quite reflect all that initial hype? Trust me, it happens all the time. And the culprit? It almost always boils down to a massive misunderstanding of how costs actually behave in the real world. So, are hidden costs completely destroying your profits? Well, in this explainer, we're on a mission to unlock the absolute secrets of managerial decision-making. We're going to look at exactly what financial information you should be paying attention to and, honestly, what you absolutely need to ignore. Welcome to this explainer on marginal and absorption costing, the manager's toolkit. Now, I know what you might be thinking. Accounting math, really? But stick with me here. We're going to take some of these seemingly dry concepts and transform them into vital, dynamic, survival tools for your business. Because really, these concepts are the secret weapons that top managers use every day to navigate all the crazy risks and uncertainties of the business world. All right, here's our roadmap for today. We'll start with the basics of costing, then we'll contrast marginal versus absorption costing and unlock the power of contribution. After that, we'll learn how to identify relevant costs, and finally, we'll put it all to the test with some real-world business decisions. Let's dive in. Section 1. The basics of costing. Whenever you make a business decision, you're essentially making a bet on the future. And to manage that future risk, you've got to realize that not all costs behave the exact same way. It's absolutely crucial to separate costs that are tied directly to your volume of production, like the raw materials in your product, from what we call a period cost. Period costs, things like factory rent or administrative salaries, are just related to a period of time. Think about it. You have to pay your rent whether you manufacture 10 items this month or 10,000, right? Time passes, the cost hits. Simple as that. Moving right along to Section 2, marginal versus absorption costing. This brings us to the core conflict of this whole explainer. What on earth do we do with those fixed overhead costs we just talked about? Well, absorption costing, which is what you use for formal external reporting, takes all those costs, fixed and variable, and just crams them into the cost of the product. But marginal costing? That's a whole different ballgame. That's your internal decision-making tool. It only includes the variable costs, the costs that pop up just from producing one extra unit. It treats those fixed period costs like a separate hurdle you have to clear later, rather than baking them directly into the product itself. To put that into perspective, let's look at Green Limited's income using both of these methods. Notice the net income here? It shows up as N1,100 under absorption, but only N900 under marginal. Why the difference? Because absorption costing actually trapped N200 of fixed manufacturing costs inside the unsold inventory sitting in the warehouse. It created this total illusion of higher initial net income. Marginal costing, on the other hand, immediately releases those fixed costs. It gives you, the manager, a much clearer, immediate picture of your real cash flow and profitability. All right, Section 3, the power of contribution. So because marginal costing strips away all that extra accounting noise, it lets us shift our focus to the absolute best tool for short-term decisions, the contribution margin. I want you to think of this not as your final profit, but more like a fund or a pool. Every single time you sell a product, you subtract the variable cost it took to make it. What's left over? That's your contribution. This pool of money is the vital bridge between selling a product and eventually covering all those heavy fixed costs, like your rent and salaries, before you finally hit true bottom line profit. And that brings us to the golden equation. Sales minus variable costs equals contribution. S minus V equals C. It is elegant, it's simple, and it is literally the foundational language of highly profitable managers. It cuts through the complex allocations of fixed overhead and tells you exactly what each and every unit brings to the table. And once you actually calculate that contribution, a whole new world of strategy just opens right up for you. Look at the powerful ways you can apply this simple equation. You can use it to set your selling prices, to point pin exactly when you'll break even, or even select the most profitable mix of products if your machines are maxed out on capacity. It also helps you decide whether to make a component in-house or just buy it, and figure out if you should accept a special, lower-priced order. Which leads us to Section 4, identifying relevant costs. Now, to apply marginal costing properly, you actually have to learn what financial information you need to completely ignore. Seriously, we only care about relevant costs. These are future differential cash flows that are going to vary depending on the specific decision you make. Look, if a cost is going to be exactly the same, regardless of whether you choose option A or option B, then it is 100% irrelevant to the choice at hand. For short-term tactical decisions, we only look at costs that will actually change based on the moves we make today.
And that brings us to the ultimate irrelevant cost, which is defined perfectly by the Chartered Institute of Management Accountants, sunk costs, costs that have been irreversibly incurred. Honestly, agonizing over sunk costs is like crying over a terrible, non-refundable plane ticket you can't even use, or forcing yourself to sit through a terrible movie just because you paid for the ticket. It's in the past. Let it go. Because they have zero value in future decisions, sunk costs must be completely ignored by a strategic manager.
Okay, Section 5, Real-World Business Decisions. Let's take everything we've covered and apply it to a classic high-stakes scenario, the make-or-buy decision. Should you manufacture a component yourself or outsource it? Here's the flow. First, grab the supplier's quote. Second, compare it strictly to your internal variable costs. Remember, we ignore general fixed costs because, hey, rent stays the same either way. If the supplier's quote is higher than your internal variable cost, you keep it in-house. And finally, always step back and assess the qualitative factors, like is this outside supplier actually going to be reliable? Scenario 2 is all about special order pricing. Check out this mystery-facing Shakura Nigeria Limited. They make this product called a slimming stick. Normally, they sell it for $20K. If we break down their costs, it's $10K in variable costs and $4K in fixed costs, making their total cost $14K per unit. Well, suddenly a new customer comes along wanting a massive special order, but they only want to pay $13K per stick. Now, $13K is obviously lower than their $14K total cost, so should they reject it? I mean, it seems obvious, right? Well, what's absolutely fascinating here is the answer. Yes, they should accept the order. No way, right? But here's why. Assuming they have the spare capacity, that $13K price easily covers the $10K marginal cost. The fixed costs, those are already being covered by their regular day-to-day sales. So every single unit they sell to the special customer at $13K adds $3,000 in pure contribution directly to the bottom line. An order that looks like a totally bad idea under absorption costing is actually highly profitable. Let's look at a third scenario, profit planning against the competition. M&K Industries wants to maintain their N50,000 profit, but they have to drop their prices to stay competitive. How do they do it? By calculating their required total contribution, they can perfectly map out their sales targets. Check out how these units scale. If they reduce prices by 5%, they have to sell 34,286 units. A 15% drop? That requires 48,000 units to hold on to that exact same profit. The marginal costing formula basically gives them a super precise, actionable roadmap. Now hold on, a quick word of warning before you run off and approve every single discounted special offer. While the math behind marginal costing is incredibly powerful, a smart manager absolutely must perform a qualitative check. Think about it. If you sell on the cheap to a special customer, will your regular customers find out and get furious? Is there maybe a better, more profitable use for your factory's excess capacity? And are you 100% sure those fixed costs won't suddenly jump up? Real-world strategy is a balancing act. It requires both the math and the context. By pulling apart your variable and fixed costs and focusing purely on that contribution margin, you basically strip away all of those accounting illusions that can paralyze your decision-making. So I want to leave you with this final provocative thought. Take a hard look at your own business operations or the company you work for. Is your current pricing strategy hiding your true profit potential? Thank you so much for joining me on this explainer, and keep exploring.